What's up, Cakers? Ruben Tech here with another great video for you today on covered calls. In my last video, which I'll link down below if you haven't watched, and I suggest doing so if you're a complete beginner, I made a controversial statement that you can technically never lose on a covered call. Now, I'm going to stand behind that statement, but first I want to tell you I'm not a financial analyst. I'm not a fiduciary. I'm just here for your entertainment. Please do your own research. But with that said, I do want to defend that statement. The reason is that when you sell a covered call, you have to own 100 shares of the stock prior to selling the covered call. And when you do, you collect a premium for selling the covered call itself, and you get that premium up front, and it is never affected. They cannot take that away from you. Now, if the stock goes down, you are not losing on the covered call itself. What you are losing out on is on the stock, and you own that anyway. So technically, you're not losing on the covered call. You're losing on the stock. And other people look at the flip side and they'll say, yeah, but what if the stock price goes above and you get assigned? Well, if the stock price goes above and you get assigned, one, you're still making money because it's going above the break-even point, which is always above where you were the stock at the moment. So when you sell a covered call, the break-even point for you is always going to be above the current price of the stock. So no matter what, you're going to make money in that sense. That 100 shares, when you get assigned at it, with your premium plus whatever the strike price is that you're going to sell it, will end up being more than what it was valued at the moment you sold that call. So you're never going to lose that way. What you are going to lose out on is that you are capping your potential gains. And so in Robinhood and their profit simulator, they will count that as a loss, but I don't think that's truly fair because you're actually not losing anything. You are losing out on gains, but it's like if I sold a stock and then the next day it goes up, right? And I'm emotionally insecure, and then all of a sudden like, oh my God, I shouldn't have sold it, right? I do it all the time, so don't feel bad if you do it too. It's what I'm trying to do in my maturity process here is I'm trying to get more rational, right? But the simple fact is you should have a plan when you do this, and you should be prepared to be assigned. And if you are and you're okay with that, then you're going to see hopefully you'll see big gains, right? And those gains, right, those are all we're concerned about. So you can't look at what, oh, I could have had this. You just have to say, hey, I was looking for 10%, I got 10%, or I was looking for 5%, I got 5%. I want to go ahead, I'm going to give you an example of this today. Okay, so first things first, let's look at Meta. I have a way out of the money call on this. I do not want to get assigned to Meta. I've been selling continuously way out of the money calls in this account. You do know that in my other account, if you watch my channel, I got assigned a few weeks ago for 200 shares of Meta. It was soul crushing, even though I made a lot of money on the covered call and on the rise in the stock price. The opportunity loss still bugged me greatly. And it's kind of funny because it immediately came back down the next week. But that's why you always got to be prepared to get assigned emotionally, right? And that's where I'm still trying to develop. And that's why I'm not a financial advisor. I'm just a guy like you. I'm out here. I'm learning things, okay? But on this account, I do not want to get assigned to Meta. So I sell it way out of the money, $680. I get to collect $212 on this, right? I've made $75 so far on it. I think it's priced at $1.36. So right, there's 136 more dollars I can make on this. This one's way out of money. Meta's at like 574, so it would have to move $106. That's not impossible. What is that, like 17% or something? It's not quite, yeah, it's not 20 for sure, about 17%. That is possible, especially with earnings coming up. This is after earnings, but I don't think it's too likely. If I do start thinking that maybe, right, it's going to happen, well, I don't know. Look at this. It's $680. The stock's at 580. I'd be getting $100 on 100 shares. I'd be making $10,000 plus the tiny premium here. It's not like I would be losing out. And that's what I mean by you technically can't lose. And I'm going to show you that more in detail right here with NVIDIA. So next up, we have NVIDIA. Here with NVIDIA, this isn't my main account for NVIDIA. I have most of my shares in another account. So in this account, I decided to do this with the intention of selling the covered call. Now, NVIDIA is going up like crazy. You might say you don't want to get assigned to Facebook, but you do on NVIDIA. Again, most of my shares are in another account. On those, I would never want to get assigned. So much so that I'm not even bothering to pretend to sell way out of the money covered calls. But here, I did this specifically with the purpose of selling a covered call. And I will explain why at the end. But first, let's look at the fact that my strike price is 136 on this, and NVIDIA has already soared to 144. So here is an example where I am losing out on, I've capped my potential gains. Okay, so I'm losing out on opportunity. However, I want to show you that I have still made money. I'm not technically losing anything. So remember, I bought these 100 shares, sold this call immediately. So my cost on these shares was 132.34. Oops, sorry. 32.34. And I get that from over here because my cost basis was $13,234. So I just divide that by 100. Okay, and that's my cost per share. Now, what happens is that 136, right? So from that, I'm going to go ahead, I'm going to put a negative on this, and I'm going to add plus 136, okay, plus the premium I collected of $584.32. Okay, this is what I collected up front. And you might say this is negative because it's a credit to me. We got to divide that by 100, 584. Okay. $9.50. Okay, so this is what I've made. I did this on 11/08/2024. So this is the max I can make in this trade now. I've capped my potential gains at $9.50 per share. So I times that by 100 shares, right? $950. I mean, obviously, pretty good money to make. You're talking about a month. It's literally 1 month, 11/08. And I think I did this on 11/09. So it was 1 month out exactly, right? So let's say 9.5, we're going to divide it by 132.34 to see what percentage it is of what I had to invest. Okay. So that's 7.17. And now I have 1 month. So I'm going to times that by 12. So these types of returns, if I did this and I successfully did this for a year, that would be an 86% return. Now, NVIDIA, of course, has returned much more than that. But this is for something that is not as risky if you know how covered calls work. Okay, because I'm collecting that premium up front and I can never lose that. Okay, the stock can go down, but that's the stock. This covered call, I'm never going to lose that premium unless I decide to roll it over or sell it because I don't want to get a sign. Okay, however, this is what I was going to say. So just so you know, again, if NVIDIA closes above 141, what was it, 141.84, no matter what, I'm going to make $950. I'm going to make 86% annualized on my return. But let's just say it closed today. I would lose this, not lose, I'd miss out on the opportunity. And what did I say that was? 141.84, right? On $2.65. And so that would just times by 100 by $265 more. And that's what I want to make crystal clear. I've made, if I get a sign on this and they sell my NVIDIA, yeah, my potential loss, my opportunity loss could be very great, right? But from where I started in the prior month, I'll have made $1,000 on a roughly $950 on a $13,234 investment in 1 month, right? So that's not too bad. Okay, that's all I got for you today. Have a great day.